In this video, I cover all you need to know about qualified dividends. I also cover the qualified dividends versus ordinary dividends tax rates. If you meet certain requirements, the tax rates on qualified dividends could be as low as 0% or as high as 20%. Please note that this entire discussion is relevant only for taxable investment accounts. First, what are dividends and their important dates? Dividends are distributions made by corporations to their shareholders. Also, exchange-traded funds as well as mutual funds pay dividends too. Whenever a company declares a dividend, there is a so-called record date. You must be on the company's books as a shareholder as of the record date to get dividends. Once the firm sets the record date, there is the ex-dividend date. Stock exchanges set the ex-dividend date one business day before the record date. Thus, if you buy a stock on the ex-dividend date or after, you will not receive the dividend. Consider an example of Intel. Intel announced a dividend on February 22 in this press release. The dividend is payable on June 1st to stockholders of record on May 7. Based on this, the relevant dividend dates are as follows: declaration date on February 22nd, ex-dividend, the record date on May 7, and the payable day when the actually dividends will be paid is June 1st. What is the qualified dividend? Qualified dividends are distributions that are taxed at a preferential tax rates, which are 0%, 15%, or 20%. These tax rates as well as tax brackets are exactly the same as for long-term capital gain. Your brokerage will show qualified dividends in box 1b of the Form 1099 DIV. Qualified dividend income must meet all of the following three requirements. The first one is that you must receive the dividend from domestic corporation or a qualified foreign corporation. The second requirement is that the dividend that you received must not be the type that is specifically excluded by the regulation. I'll give an examples a little later. And the third is that you must satisfy a certain holding period. If a dividend doesn't meet any of the following requirements, it is considered an ordinary income, and it is reported in box 1A of your 1099 DIV form. The next question is, how are dividends taxed? Here's a table that shows tax rates for qualified dividends income. Let's compare them to the tax rates for ordinary dividends. We see that the tax savings can be substantial. Here's an actual tax savings for single and married filing jointly for $10,000 dividend income. For instance, suppose you're married filing jointly. Your total taxable income is $80,000, of which $10,000 are dividends. The tax savings are $1,200 or 12%. That is $1,200 that stays in your pocket. What is the qualified foreign corporation, which is one of the requirements for a qualified dividend? It is a corporation that meets one of the following conditions. It could be just one. The first one has to do with the fact that this corporation must be incorporated in the US possession. Second, if it's not, its dividends must fall under the comprehensive tax treaty between the US and the respective country of its incorporation. Also, the third, if any of the condition 1 or 2 are not met, it can still be qualified for incorporation if its stock is traded on National Securities Exchange. The National Securities Exchange includes all the major stock exchanges as well as option exchanges, but it excludes over-the-counter markets. For instance, a firm that is traded on Tokyo Stock Exchange is a qualified foreign corporation. This is so because there is a tax treaty between Japan and the US. For a complete list of countries that have a tax treaty with the US, refer to a link that I included in the description. The next requirement for qualified dividends is that IRS says that certain dividend distributions cannot be qualified dividends income by law. While the exclusion list is long, examples of excluded distributions are the following: capital gain distributions, dividends received from deposits with credit unions, mutual savings banks, and such, dividends received from tax-exempt organizations or farmers' cooperative, and dividends paid by organizations from their employee stock ownership plans. There are also a few other narrow circumstances that render dividends unqualified. For a complete list, refer to the IRS publication 550. I included a link in the description. The third and most important requirement for a qualified dividend is the holding period. In particular, you must hold a stock for 61 days or more during the 121-day period. The 121 period begins 60 days before the ex-dividend date. When counting days, exclude the day of your acquisition and include the day of sale. Let's break this down with an example. Consider a company XYZ. You bought 1,000 shares of its common stock on July 5th. XYZ paid a cash dividend of 10 cents per share for the shareholders on record as of July 13th. This makes the ex-dividend date July 12th. You later sold XYZ stock on August 8th. The question is your $100 dividend income considered a qualified dividend? Let's look at the timeline. We see that the 121-day period starts on May 13, which is 60 days before the ex-dividend day of July 12. The 121-day period ends September 10. Because you bought XYZ stock on July 5th, the holding period starts on July 6th, because you exclude the day of acquisition, and ends on August 8th. This makes your holding period 34 days, which is under the required 61 days. Thus, you have no qualified dividend income. Your entire dividend income is reported in Box 1A or ordinary dividends of 1099 DIV form. Now, reconsider this example and assume that you bought the stock on July 11 and sold it on September 13. In this case, your holding period was 64 days from July 12 through September 13. Therefore, you satisfy the requirement of holding the stock for at least 61 days. The $100 dividend income is recorded in Box 1B of your 1099 DIV form as qualified dividend income. If you own a preferred stock, the holding period rules are a little different. You must hold the stock more than 90 days during the 181-day period. The 181-day period begins 90 days before the ex-dividend date if the dividends are due to periods totaling more than 366 days. If the preferred dividends are paid in less than 367 days, the holding period test is 61 days or more during the 121-day period. The other issue that you must grapple when calculating your holding period is the diminished risk of loss. IRS says that the day count for holding period must be for unhedged stock positions. This means that you should not own any covered calls, options, or puts for the dividend stock. In case you do, the risk of loss is diminished, and you may not count those days. Diminished risk of loss arises when any of the following happens. You had an option to sell or under obligation to sell, or made a short sale of substantially identical security. The second condition is that you were a grantor or writer of an option to buy substantially identical stock or securities. And the third point is that your risk of loss is diminished by holding one or more other positions in substantially similar or related property. In essence, condition 1 deals with owning a put option on a dividend stock. It also covers the case when you initiate a short position on another stock that is similar to the one you hold. Condition 2 deals with the situation when you sell or write call option on your stock position. This produces the so-called covered call scenario. Finally, condition 3 is the catch-all stipulation to cover all other esoteric cases. In all of these instances, you reduced your risk of loss, and you cannot count days when this happened. In essence, IRS wants investors to have skin in the game to get special tax treatment for dividends. Condition 1 is relatively straightforward to understand. If you own a put option on your dividend stock, you must exclude days you owned it from your holding period. Likewise, suppose you own 100 shares of iShares S&P 500 ETF and go short 100 shares on Vanguard S&P 500 ETF. You must not count days you held short position in Vanguard ETF for your holding period test. Unfortunately, the interpretation of condition 2 is somewhat complex. Here's what to remember for covered calls in conjunction with holding period test. First, sell only calls dated 30 days or more. Second, sell only calls that are out of the money. For instance, you own a stock that trades at $50 and you want to maintain your holding period day count. To do so, don't sell a call option with a strike price at or below $50, or calls that expire in less than 30 days. In principle, it is possible to sell calls at the money, which is strike price of $50 or one strike in the money. But to be safe, I stay away from that. In this case, I would sell or write only call options that expire 30 days or more with a strike price above $50. Fortunately, our brokers are required by law to do all record tracking on our behalf, but they won't alert you if your holding period is compromised due to faulty covered call strategy. So it is important to keep these things in mind. Finally, there are real estate investment trusts and master limited partnerships. If you don't know what the REIT is, it's essentially a corporation that owns a piece of real estate, which could be commercial buildings, industrial buildings, apartment complexes. The main source of income for REITs is rental income. There are also so-called mortgage REITs, which own mortgage securities that either they issued or they bought from banks who issued them. In this case, they earn interest income on those securities. The REITs are pass-through entities. This means that they don't pay themselves any tax, but they must satisfy this requirement of that their 90% of their income is distributed to its shareholders. Similarly, the publicly traded master limited partnerships are also pass-through entities. However, at least 90% of their income must come from the distribution, transportation, and exploration of mineral and other natural resources. REITs and MLPs do not pay per se dividends, but rather they pay distributions. And if you plan on investing in REITs and MLPs, you must be aware that the tax rules with respect to those distributions are a little bit more involved. I will have a separate video just on MLPs and REITs because they deserve their own video on its standalone video because it's just a little bit more involved topic. But in essence, the distributions from MLPs and REITs can be either ordinary income or a return of capital distributions. You can also have a so-called capital gains distributions if something gets sold and the MLP or REIT distributes that money back to its shareholders. Ordinary income distributions from MLPs and REITs are taxed as ordinary income. Conversely, the return of capital distributions are not taxed at the time of their payment. Instead, they reduce the cost basis of your investment and are essentially tax deferred. This means that once you sell your investment in REIT or MLP, you will be calculating and paying capital gain on your investment with a new tax basis that was reduced by any return of capital distributions. In practice, 70 or 80% of all MLP's distributions are return of capital. And this is so because most of the time MLPs are unprofitable due to large depreciation expense that they record on their books. And this is because they have natural resources as well as lots of equipment that they must depreciate that they use to extract or explore natural resources. REITs, on the other hand, most of their distributions are classified as ordinary income, and it's taxed as ordinary income. So this clearly puts REITs at a tax disadvantage from the investor's point of view. Income distribution from REITs and MLPs qualify for 20% qualified business income exclusion. And this is true for eligible taxpayers up until 2025. So there's some relief there until then. REITs and MLPs offer fantastic passive income opportunities for investors. You only need to know a little bit more, especially for MLPs, when it comes to taxation of their distributions. This is it for this video. I hope you got something out of it and you learned something new today. If you did and enjoyed this video, please give it a like and subscribe to my channel for more content about investing, dividends and valuation. Thank you for watching.